Hello, good morning. My name is Jamal Khan. I'm the head of tax at Churchill Tax Advisors. Today's 19th of August 2019. We are presenting our weekly tax update summary. We will move on to various cases that have been announced, but before we discuss the cases, I thought I will talk about a very hot topic for inheritance tax planning, which is wills between two spouses. We call mirror wills. I've had various discussions with solicitors, clients over the last couple of years, and I've found that there is a general misconception that if somebody has a mirror will in place, they don't have to worry about tax planning anymore. In fact, I've had clients who've come to me saying with large estates worth 15-20 million pounds, and they say our tax planning is all taken care of because we have a mirror will. So I thought this would be an opportunity for me to explain the dangers of a mirror will when people have that. And it's a very easy fix. People say for £300 all your tax planning is taken care of, because if husband dies, then everything goes to the wife, or vice versa, and therefore there's no tax to pay. Now, I'll just in my view, that's a time bomb, which gets bigger with time. I'll give you a scenario. Husband and wife both worth, for example, £4 million in together. So husband is worth 2 million and wife is worth 2 million, and they have a mirror will in place. Now, if husband was to die, leaving everything to wife, of course there will be no inheritance tax to pay because there's no tax between husband and wife. The husband would leave his estate to his wife, and there's no tax to pay. But now the estate is worth 4 million in total. When the wife dies, say in 8 years or 10 years time, the estate might be worth 6 million or 8 million or 10 million pounds, and the inheritance tax on that is going to be significantly bigger than the 4 million pounds in the outset, and that means the children will end up paying significantly more in inheritance tax. So this is a time bomb that gets bigger every year, and in my view mirror wills are okay, acceptable, but I don't think they help with inheritance tax planning at all. And people are advised to take specialist advice and then to see if this is suitable for their circumstances. And we get several cases where we've had mirror wills, and we see the second death, and the tax liability on the second death is significantly higher. Let's go back to the cases that have been announced by the first year tribunal. The first one is that of Mr. Hutchings, where Mr. Hutchings received the late filing penalty notice and from HMRC. He contested the penalty notice. The matter went to the tribunal. The judge's decision was that the penalty notice was issued, but before that he should have been served with a notice to file a tax return, which HMRC claimed that they had, but there was no evidence to prove that the notice to file a tax return had been issued. HMRC's log said on the return summary that a notice had been issued, but that wasn't enough evidence to suggest that a tax return had been filed. The judge was not happy with the evidence that HMRC put forward. Just by a computer saying yes doesn't mean that that's sufficient evidence to substantiate a claim of a notice being served validly. So the penalty was removed. The next case is that of Dr. Caldron. It's an IR35 case in a sense, where the Dr. Caldron was a GP offering his services through a limited company. He was effectively offering locum services through a limited company, but the contract between there was a contract between him and the ultimate client, which said that the services will be provided by this particular GP to the client. He was the only GP within the practice. There were no other GPs. The contract specifically stated his name. Therefore, HMRC raised assessments based on the fact that he should be liable to income tax and not the company. Dr. Caldron took this matter to the tribunal, where the judges agreed with HMRC's position. There was no substitution clause. The contract was with Dr. Caldron, not with the company. Although the payments were being made to the company, it was him that was receiving the benefit. It was him that was answerable. There were no substitution. There were no other clauses that usually we see in IR35 proof contracts. So the case was lost by the appellant in this particular scenario. The next case is that of Mr. Robinson, who was Mr. Robinson versus HMRC, who was on the shareholder and board member of Omega Holdings Limited in Bermuda. There was a dispute with the other shareholders, and he lost his shareholding and his position at the board. He made a claim for compensation and for him to receive a fair value for his shares. He made various public announcements that he was asking for a fair claim, fair compensation for his shares. He was paid ultimately £1 million. Now, HMRC argued that this £1 million should be subject to capital gains tax. Now, Mr. Robinson said, no, that's not correct. I received this £1 million because I was defamed, and they made adverse remarks about me, as a result of which I have been defamed, I've lost my earning potential, and they have made this payment to me as a compensation for defamation, which is not subject to tax as such. The matter went to the tribunal. The judges looked at the case and they said, well, the fact that you have said in public statements that this was a compensation for the loss of fair value of the shares, not defamation, therefore this should be subject to capital gains tax. And the fact that whatever the matters were between, he was a shareholder before and he wasn't a shareholder later on, and the payment that was made to him was in relation to the shares and therefore subject to capital gains tax. The next case is fairly interesting. Mr. Fitz, who was an estate agent, his marriage went into troubles, and he separated from his wife. He bought a property in 2005 where he could live and his children could come and visit him, but he stayed in that property for 3 months and sold that property, claiming that that property wasn't fit for his children to live in. Then he bought another property and he sold that 3 months later for a profit. The first property he sold for a profit, the second property sold for a profit, then he bought a third property and sold it for a profit. And with HMRC he submitted returns for one of the property, so he declared a capital gains tax, but 2 of the properties he said, well, these were my principal residences and therefore I should not have to pay tax. HMRC started an investigation and the matter was taken to the tribunal. The judges decided that Mr. Fitzjohn, he was an experienced estate agent. He knew where to look for a property and how to buy a property at what time. And for him to buy a property and then sell it 3 months later and at a reasonable profit, and for him to say that actually this was for my children and it wasn't for me, and to make the same mistake again and to buy a property and sell it for a profit, for a nice reasonable profit, and then to say this was for my children not for me, and to do it again for the 3rd time, the judges said, well, it looks more like he was looking for a profit rather than the place of settlement for him and his children, or where he could live permanently. Therefore, his claim for principal residence relief were completely disallowed. He lost on all counts, and he had to pay additional tax. In my opinion, he was badly advised, and he shouldn't have taken this matter to the tribunal because his case was fairly weak. But then again, that's how things go, unfortunately. If you do like our videos, please like on our YouTube channel, and if you would like to see more videos, please subscribe to our channel as well, so you can get updates for our new videos that are being uploaded. If you have any questions, please call us on 0207 998 1834. Thank you.